Obviously, been a lot of speculation in the markets about the prospects for a rate reduction this year. Do you think markets have effectively got ahead of themselves on this? And what sort of economic conditions would you need to see to give serious consideration of a rate cut? In discussion, for example, about the 1995 example, do you actually need to see a looming recession to cut rates, or could an insurance cut be appropriate? Thanks.
So, as I mentioned, we've just come through a two-day meeting, and we've done a deep dive on economic and financial conditions in the United States and around the world, and thought about our policy. And we do think our policy stance is appropriate right now. We don't see a strong case for moving in either direction. So we do, of course, though, as a routine matter, as you will know, we look not only at our baseline, but we also look at alternative simulations, both better and worse, and we ask ourselves what the appropriate policy response would be. But that's all we do, and I would just say that we're comfortable. The committee is comfortable with our current policy stance.
Hi, Howard Schneider with Reuters. Shifting gears a little bit, I wondered if you could flesh out, I know you're describing it as a small technical adjustment, but on the IOER federal funds spread, give us a sense of why it matters whether or not this breaches the upper limit a little bit. Is there any feed through to broader credit conditions and financial conditions that you worry about, or is it simply a matter of the Fed showing that it can control what it says it's controlling? And I do have a follow-up.
A small temporary deviation outside of the range would really wouldn't be important, as your question suggests. But we do think it's important that we be able to control the federal funds rate and generally keep it within the range. That's just good monetary policy, monetary control. So, we think it's important, and we have the tools to do that. So we've used them again today. And again, this is just a technical fix. It really has no implications for policy.
But as a follow-up on this, it is demonstrating that you control the market you want to control. And I guess the question is, at what point would these steady declines in the IOER, in steady widening of this spread, if it continues, essentially become the policy choice?
Yeah, I mean, so generally speaking, the federal funds rate, we control only directly the federal funds rate in terms of the market rate. And the transmission of the federal funds rate into other short-term rates, money market rates, has been very good over a long period of time. And that's important because it's really broader financial conditions that matter, not so much precisely the federal funds rate. So I think the Fed controlling the federal funds rate is actually important from that standpoint. And I don't see us not controlling it. So I think we'll continue to control it, and it will continue to transmit well into broader financial conditions.